For 15 years, the world lived inside an illusion. Cheap money felt permanent. Debt felt harmless. Risk felt optional. But the bill has arrived. The era of free borrowing is over, and the global system built on low rates is cracking under the weight of its own assumptions. Governments drowning in refinancing costs. Corporations trapped in debt they can no longer roll. Banks holding assets that collapse when rates rise even slightly. The mechanisms that once fueled growth are now reversing, feeding pressure back into the system that created them. The world didn't price this moment. It didn't prepare for the end of cheap money. And now the question is simple. What collapses first when the cost of survival becomes impossible to ignore? The world did not collapse into crisis. It drifted there slowly, quietly, one interest rate decision at a time. For 15 years, money was nearly free. It flowed through governments, corporations, banks, and households like oxygen. It funded everything. It softened every mistake. It allowed problems to grow without consequences. Cheap money was not stimulus. It was the foundation of the entire global era that followed. Nations borrowed as if debt had no weight. Corporations financed expansion with loans instead of profits. Households stretched further because mortgages felt harmless. Banks built portfolios, assuming yields would never rise again. This was the invisible engine behind global stability. Low rates kept governments alive. Low rates kept markets calm. And low rates kept risk dormant. And because the system kept working, people assumed it always would. But cheap money is not a gift. It is a condition, a fragile one. The world became addicted to the belief that the price of money would never turn against it. Everything was designed around that assumption. Budgets, refinancing cycles, investment models, trade flows, asset valuations, political promises. Entire economic identities were built on debt that only made sense if rates stayed low. Then the cycle reversed. Inflation rose. Central banks tightened. Liquidity evaporated. The dollar strengthened. And the system discovered the truth it ignored for more than a decade. Cheap money created growth. Expensive money reveals fragility. Debt burdens that once seemed manageable became suffocating. Governments faced interest bills larger than entire ministries. Banks holding long-dated assets discovered losses hidden in plain sight. Corporations that thrived in abundance suddenly struggled to survive. Households with floating mortgages watched stability turn into strain overnight. The structure that looked strong was never strong. It was supported by a single premise that no longer exists. This is the beginning of the real story. The age of cheap money is over. The real cost of the system is returning, and everything built on the illusion of permanence is now being tested. The diagnosis starts here. The world has seen this sequence before, not with the same headlines, not with the same technology, but with the same mechanism. Whenever the price of money rises too fast, the system built on the previous era begins to crack. The early 1980s delivered the first lesson. Inflation surged in the United States. Rates jumped to levels no one imagined possible, and countries across Latin America watched their dollar debts explode in real terms. Their currencies collapsed. Their growth evaporated. Entire regions entered what economists later called the lost decade. Not because they mismanaged their economies, but because their obligations were priced in someone else's currency and someone else's policy cycle. Move forward 2 decades. The late 1990s. A small fracture in an Asian currency peg turned into a regional implosion. Dollar loans ballooned overnight. Reserves drained at a pace governments could not fight. Corporations that looked strong on paper discovered that their balance sheets were built on assumptions about money that no longer applied. Investors fled before the worst arrived. A crisis that started in one market became a chain reaction across an entire region. Then came 2008. The world watched a liquidity freeze ripple across continents. Dollar funding evaporated. Banks from Europe to Asia realized their balance sheets were tied to the very currency whose supply they could not control. A panic that began in American mortgages became a global collapse. because every major institution relied on the same dollar pipelines to survive. 3 different decades, 3 different stories. One repeating pattern. Cheap money expands the system. Expensive money exposes it. Every crisis echoed the same truth. When the cost of borrowing rises rapidly, the architecture built during the easy years bends first at the edges. Emerging markets weaken. Highly leveraged corporations falter. Banks face silent losses. Governments struggle to refinance. And once the pressure spreads far enough, the shock returns to the center. History is not coming back as nostalgia. It is coming back as structure. The pattern is clear. Whenever cheap money dies, something critical breaks. The world believes it is living through something new. But beneath the headlines, the same old pattern is unfolding again, only larger, faster, and far more dangerous. For 15 years, cheap money covered every weakness in the system. It hid risks. It inflated valuations. It kept governments solvent. It kept corporations expanding. It kept banks comfortable. And now, the reversal is exposing everything that easy liquidity once concealed. Rates have climbed at the fastest pace in modern history. Debt costs have surged. The dollar has strengthened. And the global system built on low rates is starting to strain. The signals are everywhere. Bond yields rising unevenly across continents. Currencies losing ground against a tightening dollar. Corporations struggling to refinance debt that once felt weightless. Banks holding long-dated assets that bleed value with every tick upward in interest rates. Governments facing interest bills that grow faster than their tax revenues. For years, these institutions thrived because money was cheap. Cheap money created confidence. Confidence created leverage. Leverage created growth. People called it stability, but it was momentum disguised as strength. Now the illusion is breaking. Companies once celebrated as innovative are discovering that their business models only worked when debt was nearly free. Governments with massive refinancing cycles are realizing that low rates were not a luxury. They were a lifeline. Banks built on the assumption of permanent calm are confronting losses they never prepared for. Households that stretched their budgets during the easy years are suddenly squeezed as mortgages reset and credit tightens. Nothing dramatic has happened yet. No crash, no panic, no obvious spark. But the pressure is visible in the structure itself. Liquidity is thinning. Confidence is slipping. Volatility is rising in markets that once felt immune. This is not a random shift. It is the slow unwinding of an era that was never sustainable. The modern world is discovering a truth it spent 15 years ignoring. Cheap money does not last. And when it disappears, everything built on it is forced to reveal what it truly is. The system is not collapsing. It is exposing itself. Every financial system reaches a moment when stress stops hiding in spreadsheets and begins reshaping the structure itself. The era of rising rates has pushed the world to that moment. Not suddenly, not dramatically, but relentlessly. The first strain appears in governments. For years, they borrowed freely, rolling debt at almost no cost. Now every refinancing cycle arrives with heavier interest bills. Budgets stretch, deficits widen. Bond markets demand higher premiums for the same risk. What once felt routine becomes negotiation, and trust begins to slip from the edges inward. Then the pressure reaches the banks. Their long-dated assets lose value with every rise in yields. Losses that were invisible when money was cheap become impossible to ignore as rates climb. Liquidity thins, collateral weakens, confidence becomes fragile. A bank does not need to collapse to shake a system. It only needs to look exposed. Fear moves faster than mathematics. Corporations begin to feel the same tightening. Refinancing becomes expensive. Debt loads that once seemed healthy begin to suffocate cash flow. Investment plans freeze. Growth projections shrink. Layoffs follow. The entire corporate machine slows as the cost of survival rises. So households experience the shift in the most direct way. Mortgages reset. Variable rates climb. Savings erode. Consumption contracts. What used to be a financial abstraction becomes a daily calculation. And beneath all of this, there is a deeper structural truth. The world built too much on low rates, too much on the assumption that liquidity would always expand, too much on the belief that the cost of money was permanently anchored near zero. Now that cost is rising, and the pressure is spreading. A missed payment from a fragile government, a failed bond auction, an unexpected corporate bankruptcy, a liquidity mismatch inside a single institution. Any of these events can become the spark that tests the entire architecture. The danger is not that the system fails instantly. The danger is that it bends everywhere at once. Because once cheap money dies, leverage stops being a tool. It becomes a weight. And the weight is now pressing on every level of the global structure. The pressure point is here. The only question left is what gives way first. If the world continues on its current path, the end of cheap money will not create a single crisis. It will create a sequence, a chain reaction moving through every part of the global economy that depended on low rates to survive. The first fractures appear in sovereign balance sheets. Governments that relied on endless refinancing now face interest expenses rising faster than tax revenues. Bond markets turn hostile. Credit ratings slip. A currency that weakens under pressure sends borrowing costs even higher. A fiscal problem becomes a political crisis. A political crisis becomes a legitimacy crisis. Banks feel the next wave of strain. Their long-dated assets lose value. Their funding costs rise. Their liquidity thins as markets retreat from risk. A bank rarely collapses in a dramatic instant. It erodes slowly through withdrawals, collateral haircuts, and shrinking confidence. The system begins behaving as if failure is coming long before failure arrives. Corporations follow the same trajectory. Debt becomes heavier with every rate increase. Margins compress. Investment freezes. Layoffs spread. What once looked like expansion now looks like overextension. Growth slows, not because the world lacks opportunity, but because the cost of pursuing it has become unbearable. Households absorb the final layer of impact. Mortgages reset. Savings evaporate. Consumption weakens. A tightening of credit becomes a tightening of daily life. Then the global layer shifts. Currencies swing violently. Capital flees emerging markets. Commodity prices destabilize. Trade slows as nations struggle to finance imports. A local tightening becomes a global contraction. The architecture that once held the world together begins to transmit stress instead of stability. But even now, the story is not only collapse, it is revelation. Cheap money hid weaknesses. Expensive money exposes them. The world is entering a period where illusions fall away and only the real foundations remain. Strong institutions adapt. Weak ones fall. Systems built on fundamentals endure. Systems built on liquidity vanish. The question is not whether the dollar era of cheap money is ending. It is what survives when it does. A world built on free debt must now discover what it looks like without it. If this gave you a new perspective, do not just scroll away, hit subscribe. This is Economic Chronicles, where history exposes the present and the future is written in the lessons we refuse to learn.